Sorry about that.
You're fine. Brad, so I've been doing a little bit of talking before you got on camera about who you are and what you do, but why don't you introduce yourself and tell us a little bit about yourself from your perspective?
Sure. So I've been in real estate about 30 years. About 20 years of that, I was really more in what you're doing. I was really more kind of boots on the ground, did brokerage, and then that led into development. So I did shopping center development and a lot of net lease, freestanding net lease. So the Walgreens, CVS, Advance Auto Parts, all that stuff. And pretty much the Southeast US. And yeah, I built a couple grocery anchored shopping centers. And then 2008 and 9 was kind of the, I'm sure you were there too, but we all had this transformation. Actually I did some brokerage business right after the recession in 2010 and 11. And it was always my passion to kind of be a writer, I guess you could say. I don't really consider myself a traditional writer.
I think we were kindred spirits, and now I really know.
But I did write, full disclosure, when I was in high school, we had a newspaper, and I wrote the rap review column. I was like a rapper. And yeah. So
I would not
anyway.
have guessed that in a million years. See, we're getting
Yeah.
this is what I love.
Yeah.
So let me tell you a little bit about the audience and who's watching today, because this is kind of just a really casual, informal setting. We
Sure.
have people from all over the country and all over the world, Sotheby's agents tuning in to seek your expertise and your advice in this kind of changing time of uncertainty. They're looking for deeper insight into what's happening in their local markets, as well as what's happening nationally and globally from an expert point of view. And then we have a lot of, people who are just average Americans who are home trying to figure out this space. Maybe they're first-time investors, maybe they have a small portfolio, but kind of some insights there. So I'm going to try to kind of stay away from the jargon and the tech speak and keep it really natural and simple and expand our audience into everyday homes. So sure. Obviously, I'm going to be putting some articles that you've posted recently below. You are the Forbes chief editor for the real estate investments and a global expert in the REITs industry. So I want to make sure that I'm highlighting your technical expertise in the comments so people have access to that deep insight and you're accessible to them. But I also just want to make this an easy conversation for just every American to understand. So my biggest question for you is, we don't really know where we're going until we know where we've come from. So let's talk a little bit about the real estate industry and what was happening, fall of last year and coming into this year before the whole COVID-19 outbreak.
Sure. Well, a couple of things I want to say. First off, my mother's been in residential real estate for over 30 years. And she works for one of your competitors. I won't mention that on this call. But
no offense, she can still join the team. She's always welcome.
Exactly. I think there's, I'm trying to remember if there's one in her market. So we're actually in Greenville, Spartanburg, South Carolina. And I think you may have a franchise or a location there. But anyway, so I kind of grew up, I guess my point is I grew up in this business. That's really what I've always been. My father had hotels and he was in that business. And so always loved real estate. And it's funny, I mean, I read a book when I got out of college called The Art of the Deal, and ended up, really was inspired to become a developer. And so I wrote 2 books in 2016. I wrote a book called The Trump Factor, and that was published just before the presidential election. And it was a real estate book. Well, it is a real estate book, and it's just all about his real estate. But the other book that I'm really proud of that I also co-wrote in 2016 was called The Intelligent REIT Investor. And this book is used at many classrooms around the country, like Georgetown and NYU, Cornell, and I lecture at those schools as well. So it's a real estate securities book. And we've sold quite a few thousand copies. I'm actually I'm using this downtime that we all have to work on the second edition of that book. And hopefully I'll have that completed in the next month or so. But back to your point.
If you want to see links, an Amazon link, I'll go ahead and put that in the comments too, so access to your book. Perfect.
And again, so I cover the real estate investment trust. So just I'll kind of really at a high level, this is basically a stock in the form of real estate. So when you invest in a REIT, you essentially are investing in shares of publicly traded companies that own the highest quality institutional real estate, really globally. So we cover about 150 US companies that range from very small companies to very large companies, and really in every imaginable real estate sector. So obviously, single family housing is certainly one of those sectors we cover, and those are more the rental market, obviously. And then we cover manufactured housing, which is really a nice way of saying mobile homes, but the higher end, mobile homes. And in Florida, you know what I'm talking about. These are actually really high quality.
Really high yield, absolutely.
Yes. Yeah. And then, so we cover everything. I mean, and it's really been interesting to see, kind of what's happened. So, coming out of the last recession, I mean, the economy has really gotten really strong up until this coronavirus event. Most every property sector that we cover was seeing really strong growth throughout. And some sectors have higher growth potential than others. For example, we cover the data center space and the cell tower space and really infrastructure. And those are really some of the higher growth sectors. And those are actually holding up pretty well, even through these tough times, because people actually, just for the same reason that you and I are doing this Zoom video, I mean, that's really created demand for data and data centers and of course, cell towers and so forth. So I think those sectors have actually done very well in this pandemic.
And you just did a great interview actually on LinkedIn, breaking down the industries that are really succeeding in the REIT space and how to kind of mitigate risk and have a really balanced portfolio within your REIT choices and what's going on. So obviously anyone who's out there watching and listening and you're inspired by what Brad has to say, please follow him on LinkedIn. He's got quite the presence and quite the portfolio there. There's so much more information that he is well versed in. So don't hesitate to reach out. I'll give you that link.
Great. No, that's good. And so, it's really interesting because there are some great opportunities today. And what I tell people, even though it's very chaotic and the stock market is off, substantially, we feel like it's a really good time to invest in the higher quality companies, because once this is going to be temporary. I mean, I was telling my daughter this morning, my oldest daughter lives in New York City, and I give her a shout out, Lauren. She's works at CNBC and she covers retail. I was talking to her early this morning, and I just can't believe every week, I talked to her and I said, we were joking about Groundhog Day, and now I'm like, this is not even a joke anymore. I'm like, we're 4 weeks.
Prophecy. Now I know you created it.
Yeah, exactly. So, but I mean, look, I think there's going to be some transformational shifts that come out of this. And one of the sectors that I've written about quite a bit is the mall sector. And, sure, in your neighborhood, there are some, in fact, I guess Millennial Mall, which is right there in Orlando.
They're both Simon Malls.
Simon Malls. Yep. And so, I think that sector is really going to see somewhat of what I call more transformation, because we foresee a number of retailers that potentially will go bankrupt, even at a higher extent than we've seen in 2018 and 2019. It's really been, catastrophic to them. Now, part of this new CARES Act, which is the new stimulus that just came out recently, and it's now, trying to get in the hands of many small.
500 and under, right? The business employs 500 people and under.
Yeah, but there's actually, what's interesting is there are certain sectors that you can actually get the funds and have over 500 employees. Those would be the lodging sector, which obviously has been hardest hit. That would also include the gaming sector, which is tied directly to lodging, that tourism business model. And then the third category, which is somewhat of a surprise to see, which means the industry lobbied hard, but it's the restaurants. And you can see they've really been hurt by this. So for example, this is really interesting. I read a Forbes article about a week ago on Cheesecake Factory, and the CEO decided, he was not going to pay rent, or the company was not going to pay any rent checks for the month of April. And I think he came out a little early because, in fact, Cheesecake Factory could be included in the relief package, even though they have more than 500 employees. Again, restaurants don't or kind of get the free pass. So, but anyway, that was somewhat of a precedent, and a number of companies. I mean, now it really, I would say the collateral damage really spreads pretty far and wide to not only just the restaurant sector, but about every sector. I mean, you can think the healthcare sector, for example, which we cover, which is skilled nursing and senior housing. I mean, obviously, those are right there. I mean, this started as a healthcare crisis. So obviously, these facilities are seeing a lot more risk. And but that's really essentially what I do for a living now is we analyze different companies and try to help investors manage the risk within their real estate securities portfolio. I will say this, because I've said this a lot, you should own real estate in your portfolio. You should own, and I'm sure you'll like this, you should own a house. And but I tell people, don't confuse a house with owning real estate stocks. You should have both. And we typically look at somewhere in the range of 10 to 20% of exposure in a portfolio. So if you're an investor, individual investor, or retiree, or not retired, you should consider an allocation of somewhere between 10 to 20% in REITs. And over time, this asset class is proven to be very reliable and very durable, even through difficult times and recessions. REITs have actually performed very well and recovered well, during a recession. I fully expect for the REIT sector in the U.S. to recover. But again, there's going to be some sectors like malls that we think could have some potential long-term implications.
There are winners and losers in every market reset. I mean, that's just the truth of it. And it kind of has like a cleansing aspect of really pulling out where the strength is, who the key players are, and kind of washing away maybe underperformers. Who do you foresee as being a big top point of focus that's going to come out ahead and on top in this?
Yeah, so one of the most durable sectors that I really feel like over time has done well and through multiple recessions is really, I mentioned earlier, because that's part of my bio, is the net lease sector. This is the Walgreens and the CVS. We call those freestanding properties. So these are, again, you see them driving home every day and on the main corridors. These are freestanding restaurants, whether it be, casual dining, fast foods, theaters, and so forth. And so that sector has generally held up well because they have long-term contractual leases. They're usually 10 to 15 years. So the investor can anticipate, income. Now, I will say this, because this is the first time I've really, this is a once in a lifetime event with what we're seeing with the coronavirus. There are certain subsectors in the freestanding space that I believe could really be under stress. And one of those is the theater sector, which is already in somewhat of a secular decline as it relates to, Netflix and watching, home movies. And so
now more than ever.
exactly, no question. And I don't know how many people are using my Netflix account. I think somebody got my passcode. But
they'll probably figure that out soon.
Yeah, exactly. When my bill shows up. But I think theaters you could see some bankruptcies. Those three sectors I mentioned, gaming and lodging and restaurants, got that pass, but theaters didn't. And so I think, companies like AMC and Regal are going to be under tremendously more pressure as time goes on. And we know this is going to be a temporary event, but nobody knows how temporary this is going to go. And I guess my biggest fear, and I'm sure yours too, is if this goes into August, what's the impact to back to school? I mean, obviously in the housing market, a lot of your customers want to buy a house during the summer because they're going to get the kids back squared away before school starts. And the same things for retail. These retailers want to start back to school promotions. And so this could be extremely much more disruptive if this temporary event goes on to, say, June or July.
So keeping that in mind, at the end of your LinkedIn interview recently, you had mentioned that the residential space could be a strong performer coming out of this. And I know you and I both know that people are always storing cash for moments like this, waiting for the opportunity to, increase their portfolio and capitalize. Inside the residential space, I'm seeing that a lot of speculation that there's going to be a lot of big movement following this because people are so pent up in their homes. Either they're going to be, selling because they need to transfer those assets into their small business. They maybe really thought they enjoyed who they're living with, but now find that they need to figure out two separate houses. Or, just a lot of transition inside of that space because we're now living in and using that that domain more than ever, and finding that we're not satisfied maybe and we need to change things up. So there's a lot of speculation that there's going to be a big pull following out of this in the residential housing market. What's your view on that?
I think housing is always, look, it's you know, food and shelter. And these are necessities.
Yes.
You've got to have those. And I definitely feel like, you know, more than ever. So we're really bullish in those stocks that have that necessity shelter in place. I mean, that's really, you know, where people are. And the behaviors, I think there's certainly going to be some behavioral changes as a result of this. Again, depending on how long this goes. Offices, for example, I think more people will be working from home, like I am now, because you start, after weeks go by, months go by, then you're like, well, wait a minute, why do I need an office when I can do it right here? And my refrigerator's,
our habits.
yeah, my refrigerator's downstairs and all that. So, you know, I definitely think that, you know, demand is definitely going to be higher than ever. We actually cover a company, Miranda, that's called Broadmark Realty. They're a lender to, in fact, if any of your clients are builders and they're building, Broadmark is a great resource. They're a publicly traded company. Again, we cover them. Their ticker is BRMK. Full disclosure, I do own shares in the company. And but they loan money to home builders, so basically local and regional home builders. And they have zero debt on their balance sheet, which is great during this
Nice.
economic times. And they're global. They're all over. They lend money to Florida and different markets. They're based in Washington State. But I mean, we like the company because, look, home building is still going to continue. And even though it's slowed down, in fact, there's somebody working on my home today outside. You know, we didn't stop this. So I think there's definitely going to be more demand, I think, as it relates to this. The other thing that's going to be interesting too, and I'm watching this closely because I do have kids, and one graduated from college, another one getting ready to go to college, is again, going back to this August again. What happens if this goes, you know, if we go back, you know, into that, we're in this period in August, then you're going to see kids at home, you know, and they're going to stay at home. So that's going to create more demand for that, you know, shelter in place model. So I just definitely think, you know, housing is definitely a place. And we were actually, and you know this better than I do, I mean, the housing market is really, really strong. And
Yes.
I think it's really, you know, going to discontinue. This is not like a recession. And I don't think it's going to be long lasting. I think we will recover relatively quickly, but I think, again, the longer this goes on, I could see people going into restaurants, including, you know, I'm sure if we go into a restaurant, you know, 2 months from now, I think it's going to feel really different. You know, I'm going to wash my hands maybe 4 times, you know.
There'll be sanitizer on every table.
Yeah. So, and again, think maybe there are some good habits out of that. Maybe we'll have a healthier, you know, country as it relates to this.
Really a growth opportunity, I think, you know, I mean, just all around. I think when people start to look at the positive aspects of how this is changing and shifting us personally and in our industries, and having to pivot and embrace new technology, new resources, and really kind of get strategic. They say that we grow most during times of pleasure or discomfort. And I can tell you right now, America is growing. So on that note, and with that being said, I want to make the most of your time here today. And we do have people tuning in from cities around the country. So maybe you can give us some insight. Obviously, I know here in the Orlando market, we still have crane work going. You know, real estate and construction are essential business per the governor. And all of those projects like Virgin Trains coming in 2023. Obviously, Disney is expanding and buying land. So there's a lot going on here long term in the 23-24 space that is still going to continue to happen and rise up. But what were some of the cities that maybe caught your attention pre-coronavirus, and how do you see them performing after?
Well, I mean, Florida's a great market, and we actually have set up a satellite office down in West Palm. So I've used that Virgin train from Miami to West Palm quite a bit, which goes to Fort Lauderdale, and it's great. I think, you know, I'm really excited about that product, and I've always felt like, you know, when that extension.
That mean you're coming to Orlando in 23?
Yeah. Oh, before then.
You better come say hi. Anyway.
Yeah, exactly. No, will for sure. But no, but I think, you know, Florida's just a great market in general and for investing. And, you know, a lot of the Southeast, you know, I'm in South Carolina. I mean, South Carolina's got, you know, really great quality of life. Jobs have been plentiful. Like I said, it's just, and President Trump has said this quite a bit. The economy was, we were seeing these record job numbers. I mean, it's just really sad to see, what's happened here with this, unprecedented, really what I refer to as black swan. But no, I think the Southeast is a great market. Texas, really, we cover all the states in the country. Certain markets we're seeing some supply and demand issues that were starting to concern us. I mean, we knew a recession was imminent, and it's been 9-10 years now. So, but I think most of the banks were preparing for this. Most of the REITs that we cover preparing for this. Most of your developers, even real estate owners, we're all cognizant of the fact that a recession was coming. So I don't think we've actually. I couldn't really say there's a bubble. Maybe in self-storage, you've probably seen those in Orlando and most markets. There's a lot of self-storage construction, but that's leveled off fairly substantially in the last year. We saw some supply come in hotels that were a little disturbing, especially in New York City, but that has leveled off. So we really had, from a supply and demand perspective, we were in pretty decent balance throughout the U.S. Again, one of the biggest shocks, of course, being lodging. And, they're just, you can imagine, I mean, there's just no income generation whatsoever. I just wrote this article over the weekend, and basically I said, this great American income machine, which is the U.S. economy, has been virtually shut off in terms of, our incomes. And so many companies aren't able to pay their rent. And whether it's, small businesses, some of the big businesses like Cheesecake Factory, even though, he should pay rent.
Hopefully that's not a trend. Yeah, pay your rent.
Exactly. And so, but I think in terms of the health of the U.S. economy, I think it's very, very strong. And of course, we have this opportunity zone, which most people have kind of forgotten about, is with all of this. But I mean, that's been a great piece of legislation, which is part of the Jobs Act, which I think is certainly we've already seen the success of that business model, which is, is much like a 1031 exchange, except it's a much broader, structure where any asset class virtually could be included in that. But I think overall, I mean, there's been a lot of wealth creation, and now of course we got politics that are coming down the tracks, and it's just hard to imagine everything that we're seeing today. And
really nothing like it. It's unprecedented, the time that we're in. And I kind of feel like we're in a moment in history, and that we should, capitalize and capture the opportunity versus being bogged down by the negative.
Yeah. Well, the good thing is, I mean, most of the banks are fairly healthy. So, in our businesses, where residential or commercial, there's really abundant access to capital. And obviously companies have really slowed down now just to see where this goes. But I mean, the money's there. So, and I'm looking at buying some properties myself, because I feel like, it's still a great market to be investing in real estate. And,
Orlando had some great cap rates ahead of this, and I don't project that changing.
Yeah.
Orlando,
yeah, I mean, and look, Disneyland will be back, all that. I mean, we actually cover the park space in Six Flags. And they cut their dividend. Cedar Fair cut their dividend. But again, I think that all of this is going to come back in time. And so, again, there's some really good opportunities in these companies right now where you can invest, essentially own institutional quality real estate for 50 cents on the dollar. And so I believe there's going to be significant wealth creation.
Absolutely.
Potential. And by the way, I did want to mention, because you asked earlier, so I am the editor of Forbes Real Estate. The best website is my personal website, bradtom.com.
Okay.
And so bradtom.com. My name is Thomas, but it's just really quick and simple. And we also have a business website, but that's the easiest place that people can find me. We have a newsletter and various other products and books and whatever. So,
if you want to send me all those links, I'll post them below, so everyone has access to follow you, to engage, to read your books, your articles, and just see what's going on in depth. You give great advice. I've been following you on LinkedIn for years, and so glad that we've had the opportunity to connect on some transactions here. Is there anything else you want to leave us with today?
Well,
closures.
Look, I think, it's a great time to be buying real estate. I mean, that's both of us will agree to that right now. And, there's a lot of panic. There's a lot of fear in the market. But again, this is a temporary situation. And I think, you should always consider, real estate is going to last a long time, a lot longer than this pandemic. And so,
you stand back and look at things objectively. It can't last forever. We'll come out on top of it.
Exactly. Well, and I want to thank you for letting me do this today, and hopefully we'll do this again. Like I said,
you're welcome for a follow-up whenever you'd like. I'd love to hear more about what you have going on, whether you want to touch base monthly as we progress through this or do a recap at the end of it. I'm here for you.
Sure. Sounds good.
Great to see you again, Brad. Have a great day.
Take care. Thank you. Bye-bye.